Revolving credit might feel like financial freedom, but in this episode, we break down how revolving credits might lock you into debt for the long haul.
We are back in your life, and today's episode, why revolving credit will ruin your life. Michael, maybe start by telling us what exactly is a revolving credit for those that don't know.
A revolving credit is just a giant overdraft, right? You know, when you get your first overdraft, $500, you're at uni, so you can't pay it back anyway. And the interest rate is, 12, 13% or something like that. This is effectively the same, but it's secured against your house. So it's at a home loan interest rate and not an unsecured interest rate. So typically they're 20 basis points, 10 basis points higher than just your average floating rate.
Before we talk about the hidden dangers of revolving credits, there's some really interesting stats around how large the revolving credits are in New Zealand. Talk us through the numbers.
Yeah, cool. So revolving credits that are secured against your owner-occupied house, $6.1 billion.
I wonder how much is owing against them.
I'd say most people, you fall into one or two camps. You either have nothing owing, or if you've got a 20 grand revolving, you're owing 19,500.
Yeah, that's right. Cool. Okay, what about the investment property?
Cool. So 1.33 billion. That's not really surprising. They're not as popular for investment properties, investment property clients. It's a transactional account that you'd have against your owner occupied house.
Yep. Okay. And then moving into the business sector?
Yeah. So 40.8 billion. That's not surprising because businesses need revolving credits, right? If you think about the timing of when businesses get paid, you might have to, do the work, pay for the materials, pay your staff, and then you don't get paid for 30 days after that. So a really normal thing for a business to have would be a revolving credit.
Okay, and last one, we've been talking about butter prices a lot recently. Tell me about the agri sector.
18.1 billion, right? So that's what, 4 blocks of butter to pay that off?
I think so.
Yeah.
That math stacks up for sure. So there is a lot of money out there on these facilities.
Yeah.
Before we talk about what we don't like about revolving credits, what are the positives?
Yeah, cool. So revolving credits are great for customers that have lumpy income. So you might be self-employed, a real estate agent, anything where you get, you invoice, and then some comes in at some point in the future, right? So it's not PAY, it's not a consistent salary that comes in on a regular basis. That can be great because you might get a large sum of money. You don't just want to pay that off your mortgage. You need some of that to live off, right? So you put it in a revolving credit account, you can spend some of it down, some more comes in, you can spend some of it down, you can redraw on it. But what you're ideally doing is having some left over at the end of every pay, right? So you're paying off that revolving credit over time. It's really good for people who are great with managing their money, right? So there are strategies out there where some people spend on a credit card, keep their salary in the revolving credit facility, and then pay that credit card off at the end of the month. The math on that means you will pay less interest over time because the average balance on your loan is lower because you've got your salary sitting in that revolving credit account, right? So that's a really extreme strategy of how to use that. But usually people just have their salary come in, they spend out of that account, and then they have a little bit left over and they keep it in that account, right? But you've got to be really good at budgeting for that to work because quite often it'll come in, you'll spend it all, and then you keep spending.
Yeah, and we'll get to that point in a little bit. It does work really well for some people, right?
Another one with those self-employed people, if you're saving money for tax, right? So Prov tax, GST, something like that, you may want to put it in a revolving credit account because you can, use that to reduce the balance owing on your loan, but then you still have access to those funds again. Typically, people will use an offset facility for that, but not every bank has an offset. So you can get the same outcome using a revolving credit account.
One other quick question. Who can get a revolving credit?
So to be eligible for a revolving credit, you need at least 20% deposit, which means equity in the home. So if you're a high LVR borrower, you're not usually eligible for a revolving credit facility. Not all banks have them. So some banks don't have revolving credits, or their revolving credit facility doesn't have a static limit. So when you think of a revolving credit, you think of it like an overdraft where, look, I have a $10,000 revolving credit or overdraft on day one. 5 years from now, I will still have a $10,000 overdraft or revolving credit facility. Some banks don't have that static limit, so it'll pay itself off over time. So again, often when people are asking about these, we'll have to direct them to particular banks. I think like some really good ones in the market. ANZ have a really good one. A revolving credit facility. TSB is really good as well.
What makes a good or bad revolving credit?
The amount of time that it will be a revolving credit for, basically.
But not just 30 years.
Well, sometimes it'll be like it's a 30-year revolving credit loan, but it only has a static limit for, say, 5 years, right? So it maxes out there. So there are some definitely nuances to each bank's revolving product. So speak to your broker to find out which one's right for you.
So they're the good ways we can use a revolving credit.
Yeah.
But we are about to roast the revolving credit and tell you why it will ruin your life. And we will do that after this break.
Is your revolving credit putting your mortgages under pressure? Speak to the team at Lighthouse Mortgages. Our mortgage advisors can help you restructure or refinance to get a structure that works for you. So if you want to get in touch, click the link in the show notes below. Now, back to the episode.
So Michael, why don't we like revolving credits?
Right. So I've been trying to keep it low key, under wraps up until this point. I hate revolving credits. The reason I hate revolving credits is for every 99 people that ask me, or 100 people that ask me for a revolving credit, I go, yep, okay, you can have it. A year later, we do our annual check-in, and I go, cool. At the start, you owed 30 grand. How much do you owe? And they're like, 30 grand. No one pays them off, right? They simply sit there and they'll either not pay any of it off at all because they aren't that good at managing their money, or they pay it off, make a bit of progress and go, there's 10 grand sitting in that account.
Hawaii.
Why don't we go to Hawaii? And like, honestly, I would love to see the amount of, of that, whatever it was, 60.1 billion. I would love to see how much of that is spent on going on trips to Fiji or Hawaii, because honestly, everyone just pays it off and then takes it all out as a lump sum. And most people just continuously owe in these accounts.
The airports would be a lot quieter without revolving credits.
Absolutely, they would be. It does not help you to pay your loan off. And I'm just talking generally here. For some people, you've nailed it. You're great at budgeting, rock and roll. That is not most people, right? Most people will take these out and 12 months, they'll still owe the same amount. They may owe a little bit less, but then they drop it back down again. You will pay so much more in interest with these accounts.
And I think the big thing is everybody goes in with good intentions, right? Everybody goes, okay, Mike, I can save $2,000 a month, make my revolving credit $24,000, and I'll clear it by the time we talk in a year.
Yeah.
Everybody goes in with good intentions, but it doesn't work out.
No, it doesn't. And banks know this, right? Banks have become a little bit tighter around kind of who they give revolving credits to and why they dish them out. But I when I look at it, I go, if you want to repay your loan faster, there are two ways you can do it. You can lower the interest cost or you can increase the repayments. This is along the lines of probably both. That's the attraction. You'll lower your interest cost a little bit and you can make additional repayments. Just get a table loan, get a normal loan, fix the thing, and just crank up the repayment. Like, that is literally the smartest way to pay off your loan, is to just take a normal loan out and just pay it off quickly.
Yeah. The problem with a revolving credit is the flexibility, right?
Yeah.
Is that you don't have to make that additional repayment, or you could pull that money out in a moment of weakness.
Yeah.
But I 100% agree with you. The answer is just ramping up those fixed mortgage repayments and structure, right? It's all great to have good intentions, but if you have the structure of higher mortgage repayments, you just have to make it work.
Yeah, and you know what they say? The road to debt is paved with good intentions, James.
So I think the big thing with revolving credits, Mike, is just buyer beware.
Yeah.
Is that while it sounds great in theory to have flexibility, access to some capital, if you're not structured paying off your mortgage at a more aggressive rate, it stops you from being able to take that next step in terms of an investment property, start contributing to shares, moving towards financial freedom and having options.
Yeah, I just think you have to be honest with yourself about how you manage your money.
It's hard to be honest with yourself.
It is, right? And people don't. People want to think that they're better at managing their money than they actually are. And like, the majority of people that we speak to, like you said, have good intentions. They just struggle to stick to that plan. So if you struggle to stick to a plan, if you were, when you're saving to get your house, if you're like, man, KiwiSaver, thank the Lord for it, because I can't touch it, I can't go near it, it's just happening in the background. You are just like everyone else, and you probably shouldn't have a revolving credit facility.
Yeah, definitely. Okay, so we're going to wrap it up there. Buyer beware when it comes to the revolving credit. Make sure that if you do use it, you are using it well. Otherwise, just increase your mortgage repayments. Much love to Lighthouse Financial for sponsoring this episode. Please make sure to subscribe to our YouTube channel, give us a review, give us a like, and we'll catch you next time.